Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host Shafiq Morton, and as always it's great to be with you. During last week's show we had a look at the financial considerations and the planning that had to go into the years when you were between 40 and 50. In tonight's show we're going to take you to the point of retirement and the considerations that have to be taken when you reach those golden years. Joining me in studio this evening are Jehan Ebrahim and Ebrahim Rawoot from the Oasis team. Lady and gentlemen, Assalamu alaikum.
Wa alaikum salam.
Wa alaikum salam, Shafiq.
Jehan, let's start off by taking ourselves to the point of retirement. What are the financial considerations that I must consider if I'm about to retire?
Up until now, my colleagues have been dealing with how to go about saving and investing when you are in your 20s right until the end of your 50s. Once you move into the 60-year category, many things will change for you, including you'll retire, if not at 60, in the few years thereafter. Your ability to earn large regular income from an employer will start to taper off. Your debt level should also be very low or non-existent. Your household expenses will adjust to either your children getting married and leaving the home or becoming financially independent. And then you'll have other expenses to think about, like medical care. Now, these considerations are very normal, and most people until this point would have been preparing for it. At the point of retirement, you'll be able to enter what's called the wealth harvesting phase of the investment cycle. This would include some of the most important financial decisions that you are likely to make, so it's worth spending some time to find out what this involves. In many ways, retirement is a period that allows you to celebrate all the hard work that has been used to accumulate a respectable amount of retirement savings that may take the form of a provident fund, a pension fund, or a retirement annuity fund. The value of these funds, or a portion thereof, would need to be transferred into a pension annuity fund. This contract would ensure that you receive a regular amount of money into your banking account. This could be monthly, quarterly, or even annually, depending on what suits you. Provided you have saved in the early years and have preserved all your retirement savings, your funds will be available to provide you with a suitable and rewarding retirement that is hopefully free of any financial stress.
Ebrahim, one of the most recent popular discussion topics we sought profoundly at the beginning of the year is how much money I can take out of my pension fund. What are the most recent regulations and provisions with regards to this?
I think, Shafiq, it's very important, and, just to continue what Jehan actually mentioned earlier on, is that, the rules of you wanting to transfer out of a particular retirement fund is really dependent on what type of investment you actually have. So, if you take a provident fund as an example, and these are all funds that's been sponsored by your employer, you can literally take all the money in cash. You could take a percentage of the money in cash, or you could say, well, I'm going to take all that money and go buy a living annuity with it. So that's really your choice in terms of you as an individual. If you look at retirement annuities and you look at pension funds, there's a restriction. And that restriction is that you're not allowed to take more than 1/3 in cash. Now remember, 1st of March this year, there were certain rules that came into play. And those rules are now that if the amount is above 247,500 Rand, the 1/3, 2/3 comes into play. But I think, where we decide on how much we're actually taking in cash is really the preference of the individual. We need to be careful that we don't just decide to take the maximum cash and then create some sort of liability for tax. And tax is a negative in our own life. But at the same time, say to ourselves, how much cash do I need in order to be able to manage all my short-term, medium-term, long-term requirements? So when I do retire, do I have debt? Do I have children that still need to go through education? Do I have children that's going to get married? Do I want to go on pilgrimage? There's so many options that we have available to ourselves, and all that does involve a certain amount of cash. So what we need to do is, depending on which type of retirement fund vehicle it is, we need to be able to say how much cash do we need, and that is what we then go and apply for. The rest of it, Jehan mentioned, we go and buy a pension, and that's a pension that's going to pay us an income for life.
Could you just take it a bit further, Ebrahim? Give us an example.
Well, if you take an example and, just maybe using a individual, let's call him Mr. Abrams, and, for all intents purposes, let's say he had a pension fund and he had 6 million Rand. Now, 6 million rand for Mr. Abrams. He's accumulated that over the last 30, 40 years that he's been working. So he was a very disciplined type of individual. He never cashed in his retirement savings as he moved along, and he literally is now in a position where he wants to retire. Now remember, because he's in a pension fund, he can only take a maximum of 1/3 in cash. So 1/3 of 6 million rand is 2 million rand. Nothing stops him from taking the full 2 million rand in cash. But remember the tax implications of that 2 million rand. So because he has retired, there are certain parameters in terms of what SARS says will become taxable. So the first 500,000 rand of his cash portion that he's entitled to is tax-free. Now, I mean, how nice is that, Shafiq? You're getting tax-free monies. But now there's a second and a third and a fourth tier. So your next 200,000 rand is going to be taxed at 18%. Your next 350,000 rand is going to be taxed at 27%. And if you add those three amounts together, which is 500, 200 and 350,000 rand, 1,050,000 is taxed at 36%. So now we must be careful because we're getting certain tax rewards and tax benefits. But SARS says the more cash you take in your hands, the more tax you are going to be paying. So if you do very quick calculations on a 2 million rand cash withdrawal, Mr. Abrams is going to pay 472,500 rand in tax. Now that's a lot of money. I mean, I don't think we should be oblivion to the fact that, we can just throw away hard-earned savings. So Mr. Abrams now has this opportunity to say to himself, well, you know what, I really don't need to take 2 million rand in cash. What we would encourage is take the first 500,000. It's tax-free. If we had to take the next 200,000 rand, Shafiq, we're paying 36,000 rand tax. Now take 36,000 rand and you take it into a 700,000 cash withdrawal, your effective rate for tax is only 5.14%. It's not a bad tax to pay. But what he's now done is he's created a cash reserve for himself to be able to utilize for his own personal preferences, whether it is traveling, whether it's going on pilgrimage, whether it's settled the debts. But the more cash he now eventually does take, first of all, the lower pension he's going to earn because he's buying less of a pension annuity. And secondly, he's going to be paying more taxes. So if you do the calculations, Shafiq, on a 6 million rand pension fund, if he decides he wants to take the full 1/3 in cash, he's going to pay 472,500 rand in tax. He's only going to come out with a difference which is just 1.5 million rand. But on that 4 million rand that he now needs to go buy a living annuity, assuming a 5% drawdown, he's going to get 200,000 as an annual payment, and over a 12-month period, it's roughly 16,000 rand a month. If he decided he only takes 700,000 in cash, he's buying a pension with 5.3 million rand, he's getting an annual pension of 265,000, and that now becomes 22,000 a month. So you can clearly see the difference in the end result on him taking more in cash and paying more tax versus him being tax smart and saying to himself, well, I don't want to necessarily contribute to the tax system any more than what I have, so I want to go buy a bigger pension and earn a bigger income in order to retire comfortably.
Jehan, let's go to another scenario. What happens when the amount of money, it sits there and nothing is taken out in cash?
Shafiq, the remaining amount that is not taken as a lump sum would need to be used to purchase some sort of living annuity that will pay a regular amount of money to the policy holder. In the case of a pension or retirement annuity fund, the amount cannot be less than the equivalent of 2/3 of the value of the fund. Obviously, you could transfer more than this if your cash withdrawal is less than 1/3. Thereafter, once the transfer has been completed, the rules that govern these products are contained in the Long-Term Insurance Act. These rules stipulate the limits that are associated with the regular withdrawals that may be made from this fund, where the minimum withdrawal amount is 2.5% of the value of the fund. In most cases, we recommend that your drawdown could be between 5 to 6% of the value of the fund, which can be paid monthly, quarterly, or on an annual basis.
Shafiq, maybe just to add on to what Jehan mentioned, and she's using certain parameters in terms of what you must earn and what you should not be earning. Now, obviously, we need to be cognizant of the fact that, first of all, twofold, markets are extremely difficult, and to be drawing a high drawdown rate is suicidal. Why? Because what you're going to be doing is depleting capital in a reasonably short period of time, And the ultimate result is going to be you outlive your pension. And I don't think that is any position that we need to find ourselves in. So the guideline that Jehan mentioned, which is at 5 to 6%, it's a conservative guideline to not only allow for protection of capital, but also to allow for appreciation on the capital to enjoy during your living years.
Now, facts and figures have been thrown around. There have been some figures, and my eyes have been rolling because it's quite intimidating. Please make sense of it.
No, I don't think you should be intimidated, Shafiq. I think the first thing we need to understand is, it's a big decision. We're accumulating 30, 40 years of wealth, and the first thing we need to be doing is seeking guidance, financial advice from a professional. And there's many out there, there's financial advisors, there's wealth managers, and they're going to look in the best interest of you as an individual. I think that's the first starting point. But then with that, Shafiq, and we're so guilty of it, that in the month that we want to retire, in the week that we're leaving employment, we then go knocking on many doors looking for financial advice. And I think, first of all, it's unfair to us as individuals because you're taking a 30-year accumulation of wealth and you're wanting to make an answer out of it in 1 week. And we shouldn't be doing that. So as you are approaching your retirement years, whether it is 3 years away from retirement, 2 years away from retirement, a few months away from retirement, start seeking financial advice to be able to see whether what I've accumulated, first of all, is sufficient, number one, and number two, whether I should be taking the maximum cash withdrawal and paying all those taxes, or whether I should say, well, I don't really need that amount of cash because I've got a certain cash reserve that I've accumulated, and I need to take maybe the minimum cash in order to be able to pay minimum tax. So I think this is the critical part. As individuals, we need to become proactive. We need to understand, what is the route for me to be able to go that is going to allow for financial security at the end of the day.
Right, Jehan, back to you. We see that in a living annuity, there are some financial options, ways that we can go. Can you take us through some of them?
One of the great features of many living annuities is that they provide the investor with a number of important investment options. Like all portfolios, living annuities would usually need to include a well-diversified spread of investments across the various asset classes. For example, this would include a mix of equity, property, and income instruments in such a portfolio. These investments may also include a mix of domestic and offshore instruments that may further reduce the aggregate amount of risk. The range of investment options available in the Oasis Crescent living annuities are all Sharia-compliant funds. There are 4 investment portfolios which investors can choose from. They are the Balanced High Equity Portfolio, the Progressive Portfolio, the Stable Portfolio, and the Income Portfolio. As you are retiring, it would make financial sense to look into a stable portfolio option to minimize market risk and volatility. At the same time, the stable portfolio is designed to provide consistency in tough economic environment.
Shafiq, maybe just to add on to what Jehan mentioned, and I think this is also very important. You're now entering you went through the wealth creation phase of your life, you went through the preservation phase of your life, you're now in the harvesting phase. So in your harvesting phase, you're not in a position where you really want to take the same risk a 21-year-old can afford to take. Why? Because 30 years of accumulated wealth, you want to protect it. And the best way to protect it is in a conservative, low-risk, stable portfolio. But there was one critical word in that whole exercise, and that is it's a balanced portfolio. So it's very diversified. It is giving you diversification across asset classes. It's giving you diversification across geographic regions, across currencies, across sectors. So don't for 1 minute believe that concept of, all my eggs in one basket is the case. It's not. It's a balanced portfolio, it's well diversified, it is well spread, and most importantly, it's there to protect capital over the short term, and having a conservative drawdown rate, you're allowing for at least appreciation over the medium to long term.
Right, Jehan, why is investment growth still important when we are in our wealth harvesting phase?
Shafiq, after retirement, and if you are in good health, it's normally the case that you plan for your life to continue for a relatively long period of time. Hence, we need to protect the value of the living annuity against the harmful effects of inflation, which erodes the value of your investment in much the same way as most cancers. This is also one of the reasons that we are against drawdown rates that are above 6%, as an exhausted living annuity would leave a pensioner in a position where they would need to rely on family support and/or state pension. Remember, at the point of retirement, your quality of life can be maintained, and the choices you make about continued saving and investing are just as important as the decisions and planning before you retire.
Shafiq, just to add on to what Jehan mentioned, and we continue to speak about, what is an appropriate level for a drawdown rate. And, we need to be cognizant of the fact that a high drawdown rate is going to deplete capital over a very short period in time. And there's one question no one has an answer to. If we did, we can plan very, very well. And that is, the day, the time, the month, the year that we're going to close our eyes. Because we don't know that, we need to assume that we are going to live for many, many years. God willing that is the case. Secondly, we also need to be cognizant of the fact that today we've got so much more better medical facilities available than what we had 50 and 100 years ago. I do believe that we are living healthier lifestyles. So with all that in mind, we are now starting to live longer. So if we retire too early, we need to have more money in the pot to be able to last us during our living years. And secondly, we need to make sure that there is at least a bit of growth on the investment to combat the effects of inflation. And Jehan so wonderfully mentioned it, inflation is the same effect as having cancer, and it erodes into your investment, and eventually, before you know it, the purchasing power of one's wealth has been diminished.
Ebrahim, what happens to a living annuity the day that we close our eyes?
I think it's a very important question, Shafiq, and I think let's start off by mentioning that any monies that you have in a living annuity doesn't form part of one's estate. So, we're not paying estate duty on this money, which is a good advantage. But I think what is important is the day you open up the application, you would nominate certain beneficiaries. Those beneficiaries can be the spouse, it can be the children, it can be whoever you really want it to be. But most importantly, there must be nominated beneficiaries. So the day you close your eyes, those beneficiaries then are entitled to do a couple of things. So the first thing is they can take all the money in cash, in whatever the proportion was that was allocated to them. They could continue to earn the pension similar to what the deceased was earning while he or she was alive. They could decide to take a combination of cash and they could take a pension, or they could say, well, you know what, I want to accelerate my pension and maximize it over a 5-year period. So you basically take a 20% drawdown and you wipe it out over a 5-year period. Either way, whatever decision the beneficiaries decide to choose, you've created this legacy for you to have enjoyed during your lifetime, and eventually the day you close your eyes, there's going to be a continuation of this investment onto the next level of beneficiaries. And I think it's a wonderful investment that you've created, and it's a wonderful legacy that you're leaving behind.
Now, Ebrahim, our final question. Let's say, for argument's sake, I'm unhappy with provider X, and I want to now go to provider Y. Can I do that?
Well, you certainly can, and the rules does allow for it. So, it's a process that you will follow. And, why would you be unhappy with a company X? Well, for multiple reasons. But I think, one of those reasons are that many, many years ago, we retired, we're in a living annuity, but, it's not Sharia compliant. So now you have this wonderful balanced stable fund that's on offer. It's Sharia compliant. It meets my risk profile. So I want to now be able to transfer to the Oasis Living Annuity Fund. It can happen. And again, speak to your financial advisor. You'll go through the process of what it is that you need to complete, and you continue that living annuity with your new provider, but making sure that you're now in an environment where my conscience is not going to be bothered.
Jehan Ebrahim and Ebrahim Rawoot, thanks for chatting to us.
Thank you, Shafiq.
Thank you.
And that concludes this edition of Focus on Finance. A special thanks to our guests, Jehan and Ebrahim, who took us up to the point of retirement and the financial considerations when we reach that point in our lives. Should you wish to watch this or any of our other shows, you can log into the Oasis Crescent YouTube channel. Should you wish to contact us, 0860 100 786 or info@oasiscrescent.com. Until next time, I'm your host, Shafiq Morton. Assalamu alaikum wa rahmatullah.